Good day, everybody. This is Jim Kinney, and this is the weekly market update for OptionProfessor.com. The date, of course, is March 29 and the year 2019. As always, I remind you that past performance is not necessarily indicative of future results, and short-term trading, option trading, involves substantial risk of loss, so use risk capital only, and also consult your financial consultant, your clearing firm, your good common sense, and any other people that are advising you or doing your trades to find out what, if anything, is suitable for you in the marketplace. Now, for new listeners here, I just wanted to introduce myself. I'm Jim Kinney, and I'm a graduate of Boston College, and I've been in the investment arena here for decades. I've done hundreds and hundreds of seminars on option learning throughout the nation and have educated thousands upon thousands of investors. So at the end of the day, I think I'm qualified to give an opinion in these areas. And of course, that's what I want you to understand. Today will be my views and my opinions on the markets. Okay, let's get right into it, guys, because it's been a very big week here. Let's start out by the stock market right now. You can see from my screen, it's fading off their highs a little bit, but they are up on the day. 25,826 is the Dow. And just a quick review, I'll put the S&P up because that's the one that I follow more than the Dow. We'll get that chart up here and we'll take a look at it and see what it looks like. Okay, there you go. 28.23, the high today, 28.32. And, you know, what I did want to say, let's get this chart up so you can see it really well. First, I got to share it. Give me one moment there. And I will put that into the share mode, and we are got that all done. Good. All right, now let's talk about the S&P. When we were down to 2350, just to review what I've been kind of seeing, what I've been thinking. We thought down there, due to some information from sources, that we could rally back towards the 200-day moving average. Again, I like to use the 200-day moving average as a gauge of overbought, oversold. That's my opinion. That's my view. We got way down to 2350. The moving average on the S&P was around 2750. That's 400 points underneath the average. And if you do a little percentage game there, you're talking about 15% almost underneath the average. For a big index like the S&P, that's a pretty good, shall we say, oversold situation. So every drop should be bought until we get up towards 2750, which we did. Now, we hit 2750. I started looking for other avenues to give me an idea of where we're going. Obviously, breaking through the 200-day was a good thing. And some of the Elliott Wave people who recognize patterns through Elliott Wave were indicating when we were way low that we were going to go up towards 2800, which we did. But when we broke through the 2750, they raised that target to the all-time highs of 2940. So they were looking for a potential of going towards 2940 before a major correction or a major pullback in the wave structure. And of course, there's many ways to interpret that Elliott wave, but this is one that I have been kind of listening to. So I'm still, again, last week we pulled back dramatically last Friday. Remember 460 points down on the Dow? And I was telling you then that that 2800 mark area where we went down to was support. Where did I get that from? I got that from this area here called the former highs. And you see a high there at 2800, high there, high there, high there. So that's why that was support in there. It was also support for the transports, which I'll get into in a minute, and also the Russell. So you had a lot of support down there on the big pullback last week, and we have bounced this week. I wouldn't say we bounced tremendously, but we certainly have bounced. Now the key is you're in our zone. You got the support down at 2790, 2800. You got resistance at 2860. That's your zone. Which way is it going to break? You know, who knows? It looks like it's still trying to take out the high and go up and test that 2940. Okay, so that still looks like it could be in the cards. That's not off the table. But you start breaking 2790, you start breaking 2720, then of course going up to 2940 looks a little bit more remote. Okay, so that's the story right now. Big run up, sideways, which is normal because, again, we've got the 50-day moving average underneath the 200-day on most indexes and most stocks, I think, or many stocks that I watch anyway. So when you've got a sloppy moving average relationship between the 50 and the 200-day, my feeling, my opinion is that the likelihood is you're going to go sideways or pull back because you've come too fast, too far. Now, let's also look at the cycle situation. We all know that historically, the months between October and March or April tend to be good months for the stock market, while the latter months of between May and October can sometimes be rougher. So we're not going into a great seasonal situation either. And we have, used up a little bit of the juice from the Fed, going from we're going to hike 3 times to we are on pause. And now you've got this Stephen Moore, who might be joining the Fed, who's talking about, and what I've heard he said anyway, I can't confirm it, but I've heard that there's talk about a 0.5% cut. And of course, the bond market is acting as if that's going to happen a little bit, because it's been selling off as far as the yield is concerned. And of course, prices rise in bonds when yields drop. And they have broken through some support that obviously people who thought that rates might be in an upward trajectory, they definitely broke down some levels underneath that this week. I'll get to that in a minute. But at any rate, you guys that are in the stock market probably want to get an idea of where you're at. And where you're at right now is in limbo. And what you can say here is whichever way it turns, you could have a pretty good run. Again, you might have 100, 120 points on the upside if it can break 2860. And then, of course, you may see all the way down to 26 to 2650 if something makes this thing go sour. They're over there talking in China right now with the China deal. My feeling on the China deal seems to be that it's kind of like a TV show, Who Shot JR? What does that mean? That means you hold out Who Shot JR to the end, to the ending possible, so you get as many eyeballs and as much anticipation in it as possible. So whatever you strike a deal, shall we say, the emotions are running very, very high, because people have such anticipation that it's going to happen, and they just can't wait to see what happens. And so that's where the correlation to Who Shot JR. You wait till the end of the broadcast possibly, so you can get as many viewers as possible. This is the same way this China deal seems to be being drug out. He was supposed to meet with him in March down in Mar-a-Lago, shake hands, write a deal, and obviously it was decided that the timing wasn't right for whatever reason. I don't know what they're going to get out of it. They're going to get some soybean buys maybe. They're going to get some gasoline buys, natural gas buys, and things like that. And they're probably going to get something with this intellectual property, how they're going to enforce it, this kind of thing, up in the air. So who knows what we'll get out of it, but certainly they're trying to build it into the, Who Shot JR type moment. With regards to something that I also saw, which I'll get into later as well, I saw an interview with one of the Fed members, I believe, Mr. Kaplan, on Bloomberg, and he was indicating that what he's been saying for years, and seems to be panning out, that the reason the inflation numbers, because I've been looking, when I go out to buy food and things, it seems like prices are rising. So I'm wondering, where's these CPI numbers, right? Well, obviously, there's many things that go into the CPI number, and he was indicating that we now have a systemic disinflationary environment, because with the cell phone in your hand, you can, on any item you want, do a price hunt and do all types of finagling to get a very, very good price. And so competition through the information that's on the cell phone obviously is pinching margins. And companies which I thought might be able to raise prices in the first quarter or the first half of this year, because sales might be drying up a little bit. You saw some news come out today that was not exactly tremendous as far as spending is concerned, and that kind of thing. So I thought that they'd pass along some higher prices to make up the difference, but apparently that's not easier said than done. And so that's one of the reasons why the inflation is supposed to be at 2% or better, and it's slipping pretty much underneath that. And who's to say that they couldn't even slip into deflation under certain circumstances? And that's obviously what the Fed's now concerned about as well. So again, that was interesting from the standpoint of people looking for inflation, and that's probably why things like gold can't get above 1,400, and that's probably why the dollar is stronger than people think, is because again we're in a situation. But he did say something very interesting, and he said, "Listen, everyone is looking for inflation. They're not maybe going to get it, but people are looking for margins to expand. They're not going to get it either, which means profit margins are going to be pinched. And what is that going to do to earnings? We're going to find that out next month, because earnings for the first quarter are going to start getting announced, I think, next week or the week after. So, the cat's coming out of the bag with earnings. And if this thing disappoints on earnings, and it disappoints on, shall we say, guidance, then the stock market's going to have a rough time staying above 2,800. If, of course, there's a miscalculation, like there's been many times on this stuff, then, of course, the surprise could also be to the upside. That's why we're kind of in limbo here around 2,800, because maybe big decisions don't want to be made until we get some evidence on what Q1 earnings are doing and what the guidance is going to be. Big thing that came out this week is Lyft. I'll get into that in a minute or two. But, if you're up here and you've got some good gains and you want to protect them, a couple of defensive strategies to look at is your married puts and your collar strategies, which I discuss at every one of these meetings that you become aware of. And if you're not familiar with the strategy, you can shoot me an email and I can discuss the mechanics of what the strategy is with you. Not a problem. Email to contact me is optionprofessor@gmail.com, and I'll be able to answer your questions if I can. If not, I'll let you know that as well. With regards to the markets now, let me go around the horn here and give you more information on what I'm looking at here as far as indicators, okay? Remember, I like to look at the transports. I believe the transports are very important, always have believed that, and I think they lead sometimes, so you got to be careful here. I told you last week we went down to 10,000 on the transports. You can see that there. Right, let me put that chart up a little bit higher. There you go, and see that double bottom, right? So that's very important, and that's why you don't get bearish at a double bottom. And now we're back up here to well, we hit about 10.5. Next week, if this thing rolls over, it could go right back into the soup. If it starts getting above the highs this week of 10.5, then it could take out this point here, and then you're back in the game. Okay, but if you look at your moving averages, they're still a mess, and that's the problem as well. So you can see over here, it still looks a little bit down as far as the trend is concerned overall. Let me just show you the 200-day and the 50-day so you get the idea. See, the 200-day is right around where I said the resistance is 10.5, right? So if you can close above there, that's going to be a good sign. And then if you come down and take out 10.2, which obviously it did about a week or so ago, then obviously that's not very good. But you know why you're getting the sloppy action, in my view, is one of the reasons is the technical picture on the 50 and the 200-day is sloppy. You're still underneath the 200-day, and so the market is kind of going back and forth. If it breaks to the downside, you can stick a fork in it. You start seeing this thing in the 9,000s, I think that would be a very bad sign for the transports. And if you start seeing it in the 11,000s, I think then you have a pretty much of a breathe easy type situation on the stock market. So there's something to keep an eye on as far as the market is concerned as well. Again, why is the market choppy here? Because the moving averages are still inverted, in my view. That's one of the reasons. And the market is consolidating so that the averages can catch up and maybe cross if we're going to be in a bullish mode, or go meet each other. And if it rolls over, then that's not a good sign either. So this neighborhood here between 2750 and 2850, I think is a very important neighborhood. And I think whichever way it breaks out of this neighborhood, I'd probably go with it. All right. And then what about the Russell? The Russell is obviously small caps, and they do sometimes some leading on the upside and the downside. So here you go. Again, I told you it went down to 1,500. Again, there's some support around that neighborhood, and now it's come back up. It's still having a hard time getting above 1,575, 1,580, and certainly getting above 1,600 has been a problem. So you start seeing 1,600 or better, again, might be time you could breathe easy on the stocks. And of course, if it starts blowing out 1,500, just like if the transport started blowing out 10,000, then I would probably be either out or hedged if I had exposure to the upside on the stocks, of course, in these indexes. And of course, if you're playing the indexes, that's one thing. It is a market of stocks, not a stock market. So obviously in the indexes, there will be winners and losers, but I'm just giving you the overall vibe of the index in the small caps, and on the S&P, the vibe in the large caps. Okay, so there you go. And again, that's where you are. And these moving averages, I'd like to show you real quick, so you get more evidence of what I'm talking about, price evidence. Let's move this chart up a little bit so you can see it better. Rip, move it back down here. Okay. Yeah, as you can see here, there you go. Big dump going into December, big rally back to 1,600, pull back to 1,500. Obviously, you start blowing out 1,500, that would look like this is a bear market rally. You start taking out 1,600, and it looks like whatever they did, they fixed the problem, and we're back on the bicycle. And it's, in my view, it's nice to let the market dictate your movements as opposed to play crystal ball with them as far as, try to follow the money as opposed to dictate where it is. Now you can see here, it's well underneath and it went up towards that average, couldn't hold. So that's not bullish. And of course, the 50-day being under the 200-day, that's not bullish, but it is above the 50-day again after being underneath it. But again, if you look at that graph, 1600 does look like a very much of a high point, and it does point down. So again, if this thing starts breaking 1500 and the transport's under 10,000, I would be in a more defensive position than an offensive position at that point. All right. What else do we have going on here? Let's take a look. The US dollar, a lot of people are taking a look, and then I'll get into some individual stocks that people might be keeping an eye on. The dollar, what's going on here? Yep, a little too many Y's. There you go. Okay, US dollar currently is 97, I believe. Oh, let me see here. All right. US dollar currently is, move this chart up so you can see it properly. And there you go. Oh, too much. Here we are. Okay. This is in a range, and the range has gone on for a while now, 95, 98, 95, 98. Now it's at 97. Again, as I said, if you want to be bearish on the dollar, you got to break 95, and then you got to break 94. If it does those two things, then a significant move in the dollar might be happening, and that may have an effect on things. But right now, where it's trading now, you got to call it a firm dollar. Now, let's just look at the moving averages real quick on it. Moving averages are in a positive mode. You see where I said about 95? That's where the 200-day is. You start breaking under the 200-day, that would be the first sign that maybe Rome is burning. Right now, it's above all of them, and it's in an upward trend. So being negative on the dollar looks pretty silly right now. And of course, that's one of the reasons why the gold has had some trouble getting going. And again, what the Kaplan guy from the Fed was saying is, again, it's hard to get inflation going. And without inflation, gold does have a hard time going up. So the bottom line is that you're not going to, I don't see it getting above 1400. And there is risk to gold if in fact the dollar gets strong and the inflationary numbers start slipping again. But let's take a look at GDX, because that has been a friend to me as far as the last since September, but I think it is stalled out and is turning over. Can you see that? So again, if you had profits in there, you might want to hedge them. If you had profits in there, you might want to take some off the table, because it is having some trouble getting above 24 on GDX, and it certainly has been a very nice run from 17 up to 24. Nothing wrong with that run. But again, it does look like it's having some trouble up here. The inflationary numbers obviously are not a friend to this, and the dollar being firm is not a friend either. So again, a lot of the anticipatory buying might be coming off the thing. Right now, if you're a longer term holder, you definitely want it above 20. So there's your number right there, 20. And I think that's right around with the 200-day moving averages as well. All right, let's turn over here to oil. And a lot of people are recommending oil stocks, and a lot of people are saying crude oil is going to be a good situation. And let's take a look and see what that means. Hold on a second here. I think we can get the contract up here for December, and we'll see what crude oil looks like chart-wise. Again, they said they were cutting production, and they said they were going to do all kinds of wonderful things to kind of keep the supplies in line. So that's a good thing if you're bullish. Let's take a look here at the graph. The volume has actually been enormous here. So, I mean, people have been coming into this thing with a very, very big volume. Look at that. Boom. So there you go. And, again, it's starting to look like it wants to turn. Its biggest problem, again, is still it has an inverted 50 and 200-day. So it looks like 60 is a problem. And if you can get above 60, it looks like it could shoot to 65 pretty well. And then, of course, if it goes above there, it could take a shot at 70 to 75. So again, could there be something big going on? You got to start closing above 60, and you got to start closing above 60 with some confidence. Let's take a look at the moving averages so you can see what I'm talking about. And then, again, there are a lot of people bullish on the oil stuff here. So let's take a look at that in a second as well. Yeah, you see the 60 could be problems, because you see these lows over here in the middle of last year. It's obviously having some trouble getting in there. So again, and the moving averages are still inverted to the downside. You see 53 and 58. That's not a good setup to be bullish. But look at that volume lately. That's a huge volume. So there's been a lot of people coming into this thing, it looks like. And obviously they're either very right or very wrong. Because with all that volume, there had to be sellers, right? Somebody sold into this rally, and they sold huge volume into this rally. And we'd have to see who's smarter right now. As the buyers or the sellers? As far as I can see, the sellers aren't too dumb because it has not gotten above 60 and there's big resistance there. So the sellers, in my view, could be the geniuses here if this thing rolls over from 60 and goes back to 50. And that's not off the table with these moving averages still in a negative inversion. But the market is above both of them. So again, like I said, closing above 60, showing some good strength above 60, then of course that opens the door to go to 70 or even higher. Keep an eye on oil though. This 60 neighborhood is no joke. And okay, let's see what else we got here real quick. We've got interest rates. Okay, you got the Treasury note, 241 right now, but look at this thing. This guy went from we're going to hike to had a meeting with Trump and looked at the numbers, and the next thing you know, he did an about face. So now the whole world looks like they're easing, and that's the German bonds went negative yield. I understand there's 10 trillion in negative yield and 9 trillion in corporate bonds, much of which is high yield and leveraged loans. And the other balance of it, a lot of it is in triple Bs. What that means is if triple Bs went down a level, they wouldn't be investment grade. And then if they're not investment grade, people would have to sell them. Anybody who knows anything about corporate bonds, the liquidity is not that great sometimes. And there go, if you have a tremendous amount of selling going into an illiquid situation, we know from collateralized loans, we know from other type of situations when the liquidity dries up in a debt market, it could be problematic. So I've always believed that the dynamite that will blow up things is in the corporate bond market and in the negative yield market. And I always believe that the match will be lit when the covenants are exposed that they're inadequate. And that could be done during the next slowdown or before. So be careful there. These guys are getting an ability to issue debt because interest rates are so low, people will accept anything. And the bottom line is that that's a problem, because then you have people who shouldn't be issuing debt. And the valuations on stocks are not very low right now. So these earnings reports are going to be very important. Now, again, what's happened to the debt market? Well, interest rates were rising because the guy's talking about hiking rates, right? And then, of course, we have December where the market goes into the toilet, and obviously everybody flees stocks and buys bonds. And that's how the rates go down. And that's what the rates were doing, the yields, right? Now, we had support at 280, right? It broke back in December. That's not a good sign. Then we had some support in the trading range at 260. It broke, and that's not a good sign. And now we have long-term support coming in at around 2.5, which the market may try to get back to. One analyst at one of the bigger firms indicated that she was looking for a range this year on the 10-year Treasury of 2.25 on the downside, 275 on the upside. Right now, that doesn't seem like a terrible looking range forecast. In fact, I would hang my hat on that right now. 225 worst case scenario on the downside, and then of course 275 best case on the upside right now. But as you can see on the 10-year graph, the reason I'm showing you this is you can see in this 250 neighborhood. In this 250 neighborhood, there have been high points before, and high points that have been broken sometimes are viewed as support. So right around the 240 or 235 to 250 area could be an area where it consolidates, as long as the stock market doesn't fall over and go into bed, and then the chanting for lowering rates comes back into play. Okay, getting back to the yearly chart, obviously the market is discounting the fact that the Fed's next move is a cut. You don't have to be a genius on that. Look at the yields. I mean, what do you think? You think the market thinks the Fed's going to hike next? They thought they were going to hike. Now, what is this? That's called Fed cut coming. Fed cut coming. That's what I think they're looking for. Now, again, that could very well be the case. But if it's not the case, this thing could rebound the other way. Right now, the flow of traffic is clearly to the downside. One thing I did want to note, though, the 200-day moving average on the Treasury note is around 2.9, and we hit 2.35. So if you divide that into where 2.9 is you're about 18% underneath the 200-day average. That's oversold to me. And that's why I wouldn't be getting too hairy with making big decisions down here, because it's already dropped. You understand? It's already dropped. And that means when you're almost 20% underneath the 200-day average, which is around 290, that this thing could obviously come back up again. So this is not maybe a tremendous time to make a lot of big decisions. Certainly they should have been made 3 months ago. Okay, let's see what else. Let's go over a couple of stocks real quick that you guys mind. Let's go around the round robin and pick stocks from different industries. Right now, let's talk about Apple. And Apple had a meeting with all these lovely things they're going to be doing with the iPhone and all these lovely things you're going to be able to do with the iPhone, but it did not go over that well because the market was up near 200 and we're not near 200 anymore, despite this big announcement. There's a gap down there, so you'd have to be a little careful that we might go back down there. Some people are looking for it to rally towards 220. And that's certainly not off the table if you start taking out that high. But right now it is in the stall mode, pretty much like everybody else. And they are probably looking to see what these earnings look like before anybody makes any major moves. Let's take a look at Google. And there, again, another market that had a good size rebound rally up towards 1250, and now it's back down to 1170. Again, the moving averages are probably very positive here because the market has stopped going down and started to move back up, and so the moving averages are looking a lot better. So, again, tech is where people look for growth, and the FANG stocks and MAGA, Microsoft, Amazon, Google, and Apple. Those are the ones that people try to look towards. Let's look at the semiconductors like NVIDIA, because people do, look for growth there as well. And this thing got slammed, and now it's back on the bicycle a little bit. Let's take a look at what that looks like real quick. This is your semiconductors. And again, market had a big drop from 280, 290, and then all the way down here to 120. And now we're back to 180. And it did fill in this gap a little bit, but now it looks like it's stalled out just a little bit. So again, when the markets get way away from their moving averages, I suggest people investigate looking the other way. Meaning if you're way above, like when we were up at 290, I'm sure the moving average was down lower. Let's even see where it is today. And it'll give you an idea of what I'm talking about. Yeah, it's 205 now, right? So we were probably 185. When you're at 285, you're like 50% above the moving average almost. And obviously, that's going to be a big overbought condition. So people who did hedging up there, like buying or buying a collar strategy or using married puts, they're in a lot better shape during these big drops. So again, if you don't understand collars, if you don't understand married puts, shoot me an email, optionprofessor@gmail.com. I'll be more than happy to give you a hand. With regards to right now, I am going to be signing off for this week. And again, if you have any particular questions that I haven't covered, or you'd like to have my opinion and my input on something, again, use that email address to give me an email and give me your contact information so I can speak to you. And then basically we'll take it from there. Let's just see, last before we leave is Lyft, which came out. Let's see if it's holding its water. There's Lyft, came out at 72, and today it's at 83. So they're bidding it right up, but a lot of people are saying that this is maybe getting ahead of its skis a little bit. So watch this thing for a little bit and see if it can hold its water, because 72 to 83, it already went to 88, almost 90. So it obviously had sellers up at 88, and a lot of people are thinking it may not hold its water, not unlike Snap. Maybe not like Snap, but not unlike it, meaning it comes out big, but then people start looking at the numbers, looking at the losses, looking at what they've got going, look at the valuation, and if they don't like it, it ain't going to hold 90 bucks. So keep an eye on it and be careful, because again, this could be a volatile issue. Okay, until next Friday, I did want to do this. I did want to invite anyone who's listening to invite their friends and associates to take advantage of this podcast and also the email. So again, you want to get the link every week. It's optionprofessor.com. And the link, and you can get the link through that website. And then if you want to shoot me a question or a comment, it's optionprofessor@gmail.com. Until next week, I wish everyone a great weekend and good trading. God bless you all, and we'll be back with you next Friday.